Imagine waking up tomorrow morning and realizing that money has already been deposited into your account while you were sleeping. No overtime shifts, no demanding boss, no stressful commute, and no endless grind. Just income arriving automatically because you own assets that are working for you 24 hours a day. For most people, retirement feels like a distant dream reserved for those in their 60s or 70s. But what if I told you that thousands of ordinary Americans are building a path toward financial freedom decades earlier than traditional retirement age? They're not lottery winners, they didn't inherit millions of dollars, and they aren't taking reckless risks. Instead, they're using one of the most powerful wealth-building combinations ever created: dividend stocks and ETF investing. Today, we're going to explore how this strategy can help you potentially retire early and create a lifestyle where your investments generate enough income to cover your living expenses. The concept of early retirement has exploded in popularity over the last decade. You may have heard terms like FIRE, which stands for financial independence, retire early. The idea is surprisingly simple. Instead of working until your mid-60s, you aggressively save and invest during your earning years so that your portfolio eventually produces enough income and growth to support your lifestyle indefinitely. The key difference between traditional retirement and early retirement is time. Traditional retirees may have 40 years to build their nest egg. Early retirees often try to achieve the same goal in 20 years or less. That sounds intimidating at first, but once you understand the mathematics behind compounding and passive income, you'll see why this goal is more realistic than most people imagine. Before we dive into specific investments, it's important to understand the difference between active income and passive income. Active income is money you earn by trading your time for compensation. Your salary, hourly wages, bonuses, and freelance work all fall into this category. If you stop working, the income usually stops as well. Passive income works differently. It comes from assets you own rather than hours you work. Rental properties can generate passive income. Royalties can generate passive income. And perhaps most importantly for investors, dividend stocks can generate passive income. This distinction is crucial because financial independence is achieved when passive income becomes sufficient to cover your living expenses. Let's imagine two people earning the same salary. The first person spends nearly everything they earn and relies entirely on their paycheck. The second person consistently invests a portion of every paycheck into dividend-paying companies and broad market ETFs. 10 years later, the first person still depends on working every day to maintain their lifestyle. The second person has built a growing portfolio that generates income whether they are working, traveling, sleeping, or spending time with family. The difference isn't necessarily intelligence, luck, or income level. It's often the result of disciplined investing and patience. One of the biggest misconceptions about investing is that you need a massive amount of money to get started. Many people assume that investing is only for wealthy individuals with six-figure portfolios. In reality, modern brokerages allow investors to purchase fractional shares and invest with relatively small amounts of money. A young professional contributing consistently to a 401k, Roth IRA, or taxable brokerage account can gradually build substantial wealth over time. The amount you invest matters, but the consistency of your investing habits often matters even more. To understand why dividend investing is so powerful, we need to discuss what dividends actually are. When a company earns profits, management has several options. They can reinvest those profits into growing the business, acquire other companies, pay down debt, buy back shares, or distribute a portion of profits to shareholders. That distribution is known as a dividend. When you own shares of a dividend-paying company, you receive a portion of those profits simply because you're an owner. It's one of the closest things in the financial world to getting paid for ownership rather than labor. Consider some of the largest and most successful companies in America. Many of them have rewarded shareholders with dividends for decades. These companies often operate in industries that generate reliable cash flow year after year. Their products and services remain in demand regardless of economic conditions. Because of their stability and profitability, they can afford to share a portion of earnings with investors while continuing to grow the business. Over time, many of these companies increase their dividend payments, creating a rising stream of income for shareholders. This is where the concept of dividend growth becomes especially exciting. Imagine receiving a paycheck that automatically gets larger every year without requiring additional work. That's essentially what dividend growth investing aims to achieve. A company that increases its dividend annually can provide investors with higher income over time. If you reinvest those dividends into purchasing additional shares, the process accelerates because each new share can generate its own dividends. This creates a compounding effect that becomes increasingly powerful as the years pass. Albert Einstein supposedly referred to compound interest as the eighth wonder of the world, and whether he actually said it or not, the principle remains extraordinary. Compounding occurs when your investment returns begin generating their own returns. Instead of earning money only on your original contributions, you're earning money on previous gains as well. In the early years, progress may seem slow. Let's say an investor contributes money every month and consistently reinvests all dividends. During the first few years, the dividend income might seem insignificant. Perhaps it's enough to buy a cup of coffee each month. Later, it may cover a utility bill. Eventually, it could pay for groceries, insurance premiums, or even a mortgage payment. The growth often appears gradual at first and then accelerates dramatically. Many investors underestimate how powerful this process becomes after 10, 15, or 20 years of disciplined investing. While dividend stocks are incredibly valuable, relying exclusively on individual companies can introduce risk. Even great businesses can experience unexpected challenges. Industries change, consumer preferences evolve, and economic conditions shift. That's why many successful investors complement dividend stocks with exchange-traded funds, commonly known as ETFs. ETFs allow investors to own hundreds or even thousands of companies through a single investment vehicle. Instead of betting heavily on one company, you gain diversified exposure across multiple sectors and industries. Diversification is one of the most important concepts in investing. Think of it as a financial safety net. If one company performs poorly, the impact on your overall portfolio is limited because you own many other investments. ETFs make diversification accessible and affordable for everyday investors. Rather than researching and managing dozens of individual stocks, investors can purchase shares of a broad market ETF and instantly gain exposure to a large segment of the economy. Broad market ETFs have become especially popular because they track major stock market indexes. These funds provide exposure to companies ranging from technology giants and healthcare leaders to industrial manufacturers and consumer brands. Instead of trying to predict which company will outperform next year, investors can simply participate in the overall growth of the market. Historically, this approach has proven remarkably effective for long-term wealth creation. One reason ETFs play such an important role in early retirement planning is that they help reduce emotional decision-making. Many investors struggle because they constantly chase trends, react to headlines, or attempt to time the market. A diversified ETF strategy encourages a more disciplined approach. Investors can focus on consistently contributing capital rather than worrying about short-term market fluctuations. Over long periods, this discipline often produces better results than frequent trading. Early retirement is ultimately a numbers game. The goal isn't necessarily to become extravagantly wealthy. Instead, the objective is to accumulate enough assets that your investment income and portfolio growth can support your desired lifestyle. Every dollar invested today becomes a potential income-producing asset tomorrow. Every dividend reinvested becomes another building block in your financial foundation. Every year of disciplined investing brings you closer to a point where work becomes optional rather than mandatory. As we continue, we're going to examine exactly how dividend stocks and ETFs can work together to create a powerful early retirement strategy. We'll look at how experienced investors structure their portfolios, how they balance income and growth, and how they calculate the amount of money needed to achieve financial independence. Most importantly, you'll discover that early retirement isn't reserved for financial experts or Wall Street professionals. With the right knowledge, consistent investing habits, and a long-term mindset, it can become a realistic goal for ordinary people willing to let time and compounding work in their favor. Now that we understand the foundations of passive income, dividend investing, and ETFs, let's explore how these pieces fit together into a practical early retirement strategy. One of the biggest mistakes new investors make is focusing exclusively on high dividend yields. A stock paying an 8% or 10% yield may look attractive on the surface, but yield alone does not determine investment quality. In fact, unusually high yields can sometimes indicate underlying problems within a company. Successful long-term investors often prioritize businesses with strong balance sheets, consistent cash flow, and a proven history of increasing dividends over time rather than simply chasing the highest payout available. Think about dividend investing like owning a collection of small businesses. If you own a local store, you would want that business to generate reliable profits year after year. You wouldn't care only about how much cash it distributed today. You would also care about its ability to grow in the future. The same principle applies to publicly traded companies. The ideal dividend investment is often a company that can both reward shareholders today and increase those rewards over the coming decades. This is why many investors pay close attention to companies with long records of dividend increases. Businesses that have consistently raised dividends through economic booms, recessions, inflationary periods, and market downturns have demonstrated resilience. While past performance never guarantees future results, a strong dividend growth history often reflects disciplined management, durable competitive advantages, and reliable profitability. However, even the strongest individual companies carry risk. That's where dividend-focused ETFs become extremely valuable. Rather than selecting a handful of stocks and hoping they outperform, investors can own a diversified basket of dividend-paying companies through a single ETF. This approach reduces company-specific risk while still providing exposure to dividend income and long-term growth potential. Many investors choose to combine broad market ETFs with dividend-focused ETFs. The broad market fund provides exposure to the overall economy and captures growth from a wide range of companies, including businesses that may not currently pay dividends. The dividend-focused ETF adds an income component that can eventually support retirement spending. Together, these investments create a balanced approach that blends growth and income. This process can feel repetitive, but it is one of the most powerful wealth-building mechanisms available. Each reinvestment increases ownership, which can generate even larger future dividend payments. Imagine a snowball rolling down a hill. At first, it moves slowly and appears relatively small. But as it continues rolling, it gathers more snow and increases in size. Eventually, its growth becomes dramatic. Dividend reinvestment works in much the same way. In the beginning, progress seems modest. Over time, the combination of contributions, market growth, and reinvested dividends can create significant momentum. One challenge many investors face is staying committed during market downturns. Stock prices do not move upward in a straight line. Markets experience corrections, bear markets, recessions, and periods of uncertainty. These events can be uncomfortable, especially for newer investors. However, long-term investors often view market declines differently. Instead of seeing lower prices as a reason to panic, they may see them as opportunities to purchase more shares at discounted valuations. This mindset shift is incredibly important for anyone pursuing early retirement. When stock prices fall, the value of your portfolio may temporarily decline. But if you're still actively investing, lower prices can allow you to accumulate more shares. Those additional shares may generate more dividends and potentially participate in future market recoveries. Investors who remain disciplined during difficult periods often benefit when markets eventually rebound. Another key element of early retirement planning is understanding expenses. Many people focus entirely on investment returns while ignoring the spending side of the equation. Yet financial independence depends on both factors. The less money you require to maintain your lifestyle, the smaller the portfolio needed to support that lifestyle. This doesn't mean living an extreme or uncomfortable existence. It simply means being intentional about spending and distinguishing between genuine needs and temporary wants. Consider two individuals who each generate $50,000 per year from investments. One person spends $45,000 annually and enjoys a comfortable margin of safety. The other spends $70,000 annually and still depends on employment income. Despite having the same investment income, their financial situations are dramatically different. Early retirement is not only about increasing income, it's also about managing expenses intelligently. Tax efficiency is another factor that can significantly impact long-term results. Investors in the United States often utilize accounts such as a 401k, traditional IRA, or Roth IRA to maximize tax advantages. These accounts can help investments grow more efficiently over time. Understanding how taxes affect dividends, capital gains, and withdrawals is an important part of building a retirement strategy. While individual circumstances vary and professional tax advice may be appropriate, taking advantage of available tax-advantaged accounts can accelerate wealth accumulation. As your portfolio grows, you'll likely notice a psychological shift. In the beginning, every contribution comes primarily from your paycheck. Over time, investment income starts contributing alongside you. Eventually, dividends, capital appreciation, and portfolio growth may begin adding more value than your monthly contributions. This transition is one of the most motivating milestones in the investing journey because it demonstrates that your money is starting to work as hard as you do. Many aspiring early retirees become discouraged because they compare themselves to investors with million-dollar portfolios. What they fail to see are the years of consistency behind those results. Wealth creation is usually less about dramatic breakthroughs and more about repetitive, disciplined actions performed over long periods. Investing every month, reinvesting dividends, avoiding unnecessary debt, and maintaining a long-term perspective may not sound exciting, but these habits often separate successful investors from everyone else. One of the greatest advantages dividend investors possess is visibility. Unlike unrealized gains, dividends arrive as actual cash payments. Seeing money deposited into your account can provide tangible evidence that your portfolio is generating income. This feedback loop often reinforces positive investing behavior and encourages investors to remain committed during volatile periods. As your portfolio continues expanding, you'll eventually reach a stage where dividends alone begin covering meaningful portions of your expenses. Perhaps they pay for groceries, utilities, internet service, or insurance premiums. Later, they may cover larger expenses. Each milestone represents another step toward financial independence and reduces reliance on earned income. The ultimate objective isn't necessarily to stop working forever. For many people, early retirement actually means gaining freedom of choice. Some continue working part-time. Others start businesses, pursue creative projects, travel extensively, volunteer, or spend more time with family. Financial independence creates options, and options are one of the most valuable forms of wealth available. The combination of dividend stocks and ETFs is particularly powerful because it balances stability, diversification, growth, and income. Dividend-paying companies can provide a growing stream of cash flow, while broad market ETFs can capture economic expansion across multiple industries. Together, they form a foundation capable of supporting long-term wealth accumulation and potentially funding an early retirement lifestyle. As we move into the final part of this discussion, we'll examine how investors estimate their retirement number, how much capital may be required to achieve financial independence, and how to build a realistic roadmap from where you are today to the point where your investments can support your future lifestyle. This is where strategy turns into action and where the dream of early retirement begins to look like a concrete financial plan rather than a distant possibility. At this point, the question most people are asking is simple. How much money do I actually need to retire early? The answer depends less on your age and more on your annual expenses. Financial independence is ultimately a math equation. If your investments can reliably generate enough income and growth to cover your spending, then work becomes optional. This is why understanding your lifestyle costs is one of the most important steps in the entire process. Someone who spends $40,000 per year will require a significantly different portfolio than someone who spends $120,000 per year. A commonly discussed guideline among retirement planners is the 4% rule. While not a guarantee and certainly not a one-size-fits-all solution, the concept provides a useful starting point. The idea suggests that a retiree may be able to withdraw approximately 4% of their portfolio annually while maintaining a reasonable probability that their investments will last for decades. Using this framework, an individual spending $40,000 annually might target a portfolio of around $1 million, while someone spending $80,000 annually could require closer to $2 million. The exact number varies based on market conditions, withdrawal rates, taxes, and personal circumstances, but the principle helps investors estimate their financial independence target. One reason dividend investing appeals to early retirees is that dividends can reduce the need to sell shares during retirement. Instead of relying entirely on portfolio withdrawals, investors may receive a portion of their income directly through dividend payments. This can provide psychological comfort and potentially create more flexibility during market downturns. While dividends are never guaranteed, many established companies have long histories of maintaining and increasing payouts even during challenging economic periods. It's important to remember that retirement does not mean your portfolio stops growing. In fact, many early retirees may spend 30 or 40 years in retirement. Because of this extended timeline, growth remains essential. Inflation steadily increases the cost of living over time. A gallon of milk, a monthly utility bill, or a healthcare expense that seems affordable today may cost significantly more 20 years from now. This is one reason why combining dividend income with growth-oriented ETFs can be so effective. The income supports current needs while the growth component helps preserve purchasing power over the long term. Healthcare is another critical consideration for anyone planning an early retirement. Traditional retirees often transition into government-supported healthcare programs at a certain age, but early retirees may need to bridge the gap for several years. Medical expenses can represent one of the largest financial risks in retirement planning. Building flexibility into your budget and maintaining an adequate emergency fund can help address unexpected healthcare costs without disrupting your investment strategy. Speaking of emergency funds, no early retirement plan is complete without one. Even the strongest investment portfolio cannot eliminate life's uncertainties. Unexpected home repairs, medical expenses, vehicle replacements, or economic disruptions can occur at any time. Maintaining a dedicated cash reserve allows investors to handle emergencies without being forced to sell investments during unfavorable market conditions. This safety cushion often provides both financial protection and peace of mind. Another important lesson is that the journey to financial independence rarely follows a perfectly straight path. Careers change. Income levels fluctuate. Families grow. Economic conditions evolve. Some years may exceed expectations, while others present unexpected challenges. The investors who ultimately succeed are not necessarily the ones with the highest incomes. They are often the individuals who remain adaptable, disciplined, and committed to their long-term goals despite temporary setbacks. Consider the power of incremental improvements. Increasing your savings rate by a few percentage points, reducing unnecessary expenses, maximizing employer 401k matching contributions, and consistently reinvesting dividends may seem like small actions individually. Yet over a decade or two, these decisions can dramatically alter your financial future. Wealth is frequently built through the accumulation of small, intelligent choices repeated consistently over time. One of the most underestimated advantages of pursuing early retirement is the sense of control it creates. Many people spend years feeling trapped by financial obligations. They stay in jobs they dislike because they need the paycheck. They postpone dreams because they lack financial flexibility. Building an investment portfolio changes this dynamic. Every share purchased represents another step toward greater independence and freedom of choice. There will inevitably be moments when the market tests your patience. Headlines may predict economic disaster. Stock prices may fall sharply. Friends and coworkers may question your strategy. During these periods, it's helpful to remember why you're investing in the first place. You're not trying to predict next week's market movement. You're building assets designed to generate income and grow over decades. Long-term success often comes from ignoring short-term noise and remaining focused on the bigger picture. Many of today's financially independent individuals began with ordinary salaries and modest investment accounts. They didn't possess secret information or extraordinary investing skills. Instead, they followed a relatively straightforward process. They spent less than they earned. They invested consistently. They reinvested dividends. They diversified through ETFs. They remained patient during market volatility. And most importantly, they allowed time to work in their favor. As your portfolio grows, you'll begin noticing milestones that once seemed impossible. The first $100 in annual dividends becomes the first 1,000. The first 1,000 becomes several thousand. Eventually, those payments may cover entire categories of expenses. What once felt like a distant dream gradually transforms into a measurable reality. These milestones serve as reminders that financial independence is not achieved overnight, but through steady, consistent progress. One of the greatest misconceptions about early retirement is that it represents an end point. In reality, it is often the beginning of a new chapter. Financial independence provides the freedom to spend your time according to your values rather than financial necessity. Some people travel the world. Others launch businesses, mentor younger professionals, volunteer in their communities, or dedicate more time to family. The common factor is choice. They gain the ability to decide how they spend their most valuable resource, time. Dividend stocks and ETF investing are not get-rich-quick strategies. They do not promise overnight success, instant wealth, or guaranteed returns. What they offer instead is something far more powerful, a proven framework for long-term wealth creation. By combining the income-generating potential of dividend-paying companies with the diversification and growth opportunities provided by ETFs, investors can create a portfolio designed to support both present and future financial goals. So if you're serious about retiring early, start where you are today. Open the investment account if you haven't already. Contribute consistently. Take advantage of your 401k and IRA opportunities. Reinvest dividends. Stay diversified. Continue learning. Most importantly, remain patient. The journey may take years, but every contribution moves you closer to financial freedom. The dream of waking up each morning knowing your investments are working for you is not reserved for the wealthy or the lucky. It is available to ordinary people willing to embrace discipline, consistency, and a long-term mindset. Years from now, your future self may look back on the decision to start investing today as one of the most important financial choices ever made.